Hello everyone, welcome to the WikiTrade. And today we'll go for our second session of our basic stock market course. In the first session, we discussed about some basic terms related to the structure of the stock market. And today we will go through the stock market and discuss some basic terms related to it. So first one is our IPO, that is initial public offering. And what is this IPO now? It is a significant financial event where a privately owned company offers its shares to the public for the first time, that by becoming a publicly traded company. So, as we discussed previously, that when a startup grows up, it becomes a company. It takes the money from angel investors or venture capitalists or any other. It may be they may be a person or they may be any institutional bodies, but after it becomes a company, for when it starts to grow, when it start to expand its area, business area, it requires more money. So it comes to the stock market. So when it comes to the stock market, when for the first time it offers its shares to public. So see, first I want to join some lines here that how the venture capitalist or angel investor or any type of institutional investor invest in it, how it raises money from them before the point that before it comes to the stock market, that a company has a value that is 100%. Okay, it is its total share. So it gives some share to that investor, and uh, instead of in place of that the equity share, that investor uh, invest their money, give their money to the company. So now it comes to the stock market. Now the company comes to the stock market to raise the money. That means it will give some shares to the public and take the money from the public. So when it happens firstly, in the first time, it is called IPO, initial public offering. It offers to public initial level in the first level. So now, the, before offering to the public, it was a privately owned company, and after the offering, it becomes publicly traded company. Now come to our second term, OFS, that is offer for sale, a way of for shareholders to sell their shares to the public, and it is a method for companies to reduce their holdings and meet minimum public shareholding requirements. So what happens in a company? There are some co-founders, there are some investors, and all the 100% share are distributed in between them. So when it comes to the market, when it offers to the public, their shareholding pattern reduces. Why? Because the all total shareholding pattern, all total share is 100%. That is always constant. Maybe, for example, there are suppose three persons are there, three shareholders are there, and 60 2020. So now 60 2020, when that company, that means person A has 60%, person B has 20%, person C has 20%. So when it will go to the stock market, when it will offer some shares to the public, that share will reduce from all these three persons, from all these three institutions, from all these three shareholders. So it is a way of shareholders, three shareholders, to sell their shares to the public. Okay, so uh, 60% will reduce to 58%. That 28% will be reduced to 18%. Another 20% will be reduced to 18%. So now 6% will go to the public. So it is a method for companies to reduce their holdings and meet the minimum public shareholding requirement, because there is a rule and regulation that this much shareholding, this much holding pattern must be given to the public, must be diluted in the public. So now coming to the third one, it is the FPO, that is follow-on public offer. It is a way for company to raise more capital by selling new shares to the public. So first, when the company launch in the market, it decides that it will hold back its 70% uh, I'm saying it for an example basis that it will hold back its 70% share equity share and 30% will be diluted in the market. But after revealing that, the company needs more money. So then it will that was the initial public offering. But after some years, after some time, it requires more money. That it needs that more money is required. So now it will again dilute it. The company board decided to dilute its shareholding again. So now that 70% will be reduced to suppose 60%, and another 10% will be diluted in the market in the public. So now company has 60% equity, and in the stock market 40% shareholding is there. Now coming to the next, this is called follow-on public offer, and next term is our bonus share. So when company grows, company gains profit. So how a company gains profit? With the public, with the trader, invest in that share, invest in that company. So company takes money from us, and it gains a profit. So now company decides to give some portion of profit to the public, because of public it gains the profit. So it decides to give some bonus, the bonus share to the public. So this bonus share are the extra shares that a company gives to its existing shareholders. Suppose I am a shareholder and I have 100 shares, and now 100 share of a company. Now that company wants to give me bonus, so that company will issue me some extra share. If suppose that company thinks to give me 10% extra share, I have 100 shareholder, I have 100 shares already. So now it will 10%. That means 10 numbers. So it will give me another 10 new shares. Now I have 110, 110 share of that company. Then coming to the next, this is called dividend. So when a company gain some profit, some company decides to give bonus. Like in some company, some employees are also getting bonus, but also not all the company are bound to give bonus. Now a company also, some company also decides to give the dividend. So what is dividend? It is the distribution of the profits by a company to its shareholder. So a company will decide that for one share, it will give this much dividend. Suppose 2 rupees dividend. I have 100 shares, so I will get how much dividend? That is 200 rupees dividend. Now coming to the right issue. Right issue is a way of company to raise additional capital by offering existing shareholders the chance to purchase more shares directly from the company at a price lower than the market value. So, I am existing shareholder of a company, and I have 100 shares of that company. Now the company thinks to raise money, okay, raise money, but not from all the public, but from some certain section of public. And which are this and what is that certain section of public? That means those who are already the existing shareholder, okay, not a new shareholder, not the public uh, that has not bought any share of that company. Okay, so whoever those are the existing shareholder, company thinks that they are loyal. Okay, they are means they believe in that company. Only that's why they have bought the share of that company. So company wants to give them a chance that please take please take some extra share also, and we will give it to you some lower price than the market value. Okay, suppose a company is trading in the rupees 500, and I am an existing shareholder of that company. I have already bought 50 shares of that company. So company will offer me that please take some extra share. Market is our company is trading in 500 rupees, so take it in 490 or 495 rupees. Okay, so this is called right issue. Then coming to the next, buyback share. A buyback shares occurs when a company purchases its own shares in the stock market. Through buyback, a company takes outstanding shares of the market and returns capital to the investor. So when a company needs money, it comes to the share market, it comes to the stock market, it offers some shares to the public and uh, takes the money of the public. So when company doesn't need more money, okay, company is now stable, company is growing day by day, company is in huge profit, so company doesn't need the money of public. But a share is always important, the most important thing for a company. Every company, each and every company, it may be small or big, may be multinational, but it always wants to keep its shares back in them. Okay, they never want to dilute them. Okay, in the public. So now when everything is okay, when everything is good, they also want to buy back their shares. They also want whatever the shares they diluted uh, in the market, they want it back. So now they buy back the shares from the public, and vice versa happened that they took their shares and gave their money to the public, to the investors. Then coming to the next, it is the stock split. It is a corporate action where a company increases the number of its outstanding shares by issuing additional shares to existing shareholders in a predetermined ratio. So what happened in case of stock split? Uh, Suppose 10% of a company, the 10% share of a company is diluted in the market. Company has it, the founders have 90% and 10% is in the market. But company wants to increase its share 10%. Uh, Suppose take it to understand it clearly. Company has 100 number of shares. That is 100%. 10% is in public. That means 10 number of shares is in the public now, is in the stock market. It is traded. It is traded in the. It is being traded in the market. So company will issue additional shares to the existing shareholders. Now I am a shareholder and I have some shares of that company. Now company will split their stock. That means suppose one stock will be split into 5. So 10 stocks will be split into 50. Now instead of 10 shares in market, there is now 50 shares. 1 is to 5 ratio, this stock splits. And that ratio is also predetermined. It is determined in that board of company that one ratio will be split into how many shares. But also according to the number of share, the price will also decrease. That doesn't mean that means stocks will split. That doesn't mean that one share is being traded in 500 rupees, that stock is split into 10 numbers of shares. That doesn't mean one share will become 500. No, one share is split into 10 number of shares, so value of 10 shares, now value of 10 new splitted shares is equal to 500. So one share it will be 50 rupees. And then come to the next one, it is bear and bull market. So bear means decrease, bull means increase. Okay, so when market is in a rally in the upward direction, continuously market is in green, continuously market is increasing, the value of market is increasing, that is called bull market. When the market is in crash mode, is in red color, that continuously a market for a period of time it is decreasing down, decreasing, it is called bull market. Then coming to upper and lower circuit. So in market, from retail investor to institutional investor, domestic institutional investor, foreign institutional investor, many types of investors are there. Many types of institutions, many types of persons. And that means retail traders. They are also there. So for the higher benefit, because in case of a big market, in case of a large market, always the public, always the retail trader, always the trader who trades in a small quantity, they face the loss. So to save their interest, so to protect their interest, SEBI implemented a guideline, that is upper circuit and lower circuit. Upper circuit, it is the highest price that a stock can reach in a day. In same for the lower circuit is the lowest price. That means a stock is suppose traded is being traded in 500 rupees. Its upper circuit is 550 and lower circuit is 450 for that particular day. That means suppose today the highest price will be 550. Above that 551, it cannot be traded in 551. Okay, similarly for the lowest, it can go down till 450. It can't go down 449. So trading stops when a stock reaches its upper or lower circuit. Once the stock reaches up to 550 or 450, the trading in that stock will be stopped. So why it is there? It prevents the price from rising and falling too much, so that a stock cannot goes very high or very low. Okay, it occurs when there is a lot of buying or selling interest is there in stock. When there is a lot of order, buying or selling order is there in case of a stock, this happens. So it prevents extreme price volatility and excessive loss. Then the all-time high or low. So all-time high or low, that is it is the highest or lowest price of a stock since the stock has been traded, or since the stock has been listed in the stock market, from the birth till today. Birth means since it is listed, since the stock is listed in the stock market. And 52-week high or low, similar to the all-time high or low, but it is since 1 year or 52 week. What is the highest price and lowest price of that stock? Then longer short position. So long position is when an investor buys stocks with the expectation that the price will increase. It is profitable in the bullish market. So we know about the bullish and the bull and bear market. In the bullish market, we buy a stock in the lower price and hold it for some days, for some months, for some years. It is called a long position, that one day, after 4 months, after 5 months, it will increase up to 100 points. Then I will sell it. Okay, this is called long position. And short position, when our strategy, when our expectation, or when our calculation states that no, the stock price will decrease here, decrease from here, then we short position. That means we sell it from the higher price, so that the price of the stock will go down, and in the lower price we will buy it again. And it happens in the bearish market. So this was the end of the our session 2, and this is the all these basic terms regarding stock market. And this is for today. Bye bye.